Good morning, Lady Bosses. I am Laura Caroon. I am president and co-founder of Ladyboss Midwest. Our mission is to connect and empower women, and today we are excited to be here to talk all about money. So, what does money have to do with women's empowerment? Well, women have had a pretty complicated relationship with money for many reasons. Things like, on average, women are paid less than men. Women take more time out of the workforce to care for loved ones. Women tend to be more risk averse. Women have historically been shut out of financial conversations or even the ability to build their own credit. Did you know that women couldn't even get their own credit card until 1974? We even see exclusively men's faces on our money. Although we might see Harriet Tubman's face on a $20 bill 10 years from now. And I've heard rumors that we'll see some women like Sally Ride and Maya Angelou on quarters as early as next year. But we've also been taught that men are the breadwinners and women should really only concern themselves with household and caretaking duties. Now, this is 2021 and things are definitely changing. But this exclusionary traditional narrative is still lurking in the back of our minds, and it really has left women in the dust when it comes to financial literacy and independence. So it's no surprise that many women feel maybe a little bit embarrassed around their financial history or their lack of financial literacy. And that shame often keeps women from seeking out help or further education. So as part of our goal for the Ladyboss Money Lab, was to create a judgment-free atmosphere for women to learn and feel empowered about their finances. Whether you are someone who is just starting on your financial journey, you're saving up for a house or a vacation, or you're planning to start a business, or if you want to feel secure in your retirement, we hope this will be a really great opportunity to learn from experts, to get access to resources, build confidence, and move forward in your financial journey. We are so thrilled to have partnered with the experts at Gate City Bank for this first ever Ladyboss Money Lab. So first, I want to introduce Amanda Torak, SVP of Culture at Gate City Bank, to share why they were excited to partner with us today. Welcome, Amanda.
Hi, everyone. Thank you so much for having me, Laura. So we are so excited to be here today and help make this event happen. So I have actually been with Gate City Bank for almost 7 years, and I've had the privilege of learning and seeing firsthand just how much of a passion Gate City Bank as a whole and our team members have for giving back to the communities we serve. You know, we've been around for 98 years, and we've always been a local community bank. And our main focus has been creating a better way of life in our communities. Whether it's volunteering or charitable giving, we really do believe in helping others. And we also believe in the importance of financial education. We want to ensure that everyone can feel confident in their understanding of financial options and that they can feel confident asking questions to better their financial confidence. So it's important to empower ourselves and to have a good understanding. It's vital to our financial success. So when Ladyboss connected with Gate City Bank on the idea for the Money Lab, it was a natural fit. Our focus on community involvement and providing free financial education had us ecstatic to join forces for this event. So we are so excited about the 5 speakers that you're going to hear from today. They all have some great tips and great advice for you to continue building your strong foundation of financial knowledge. So on behalf of Gate City Bank, we really hope you enjoy your time with us today. Back to you, Laura.
Thanks so much, Amanda. And thank you again for Gate City Bank for making today's event happen. So if you have a question for one of our speakers this morning, please add that in the chat or the question box that's on your screen. And at the end of each presentation, we'll have a few minutes for Q&A. So ask away and we'll try to get to as many questions as possible. If you want to share about the Money Lab on Instagram, we would love that. Please tag us, and we really enjoy seeing what you're learning. You can tag us at Ladyboss Midwest. Okay, I can't wait to get started and make the most of our time together today, so let's dig in. Our first presenter is Brandy Haugen. You may recognize Brandy from her takeover on Instagram stories on Friday. Thank you so much for being here today, Brandy.
Good morning. I am so excited to be here. So thank you for having me. I'm excited to talk about budgeting. All right. Laura, can you see my screen?
Yes, I can. Thank you.
Okay, perfect. Well, thank you again for having me. My name is Brandy Haugen, and I started at Gate City Bank in 2012 as a part-time customer service representative. I quickly found a passion for leadership and helping people reach their financial dreams. I currently am a retail manager for 4 Gate City Bank locations in Fargo and West Fargo. When I'm not in the office leading my teams, I'm active out in the community providing financial education to high school students and also supporting the women of the YWCA with financial support and education. Have you ever asked yourself, what is the best budget? Oops. Well, budgeting isn't a one-size-fits-all. The great thing about budgeting is there's many options to explore to find which budget works best for you. On the screen, you will find I have a few budgets outlined where I'll briefly give some little inside tips and what those budgets are. The first one is the zero-based budget. This is the type of budget where you list out all of your expenses and what you have coming in for income. And at the end of this budget, what you do is you subtract them and you should be at zero. So essentially, you want to make sure that all of that income you have coming in is being budgeted for expenses, and the items that are the money that's left over for at the end of it, you would put into savings account or you would allocate, so you would essentially budget all of your money. The next one is the weekly allowance. This is the type of budget where you set aside a set amount of money each week. This is also commonly used in conjunction with the cash envelope system, which I'll explain below. A good example of this would be setting aside $50 each week for food, or if you, for example, I set aside money to go to Target because that's my self-care. I like shopping and it's nice to have a coffee and walk around and take a look. The next one is budgeting by paycheck. This is where you would review what you have coming in for income each month and then what bills you have to pay. So an example of this would be, say you have your rent due, car payment, credit card, and student loan for expenses each month. You would take a look on how you want to, or when you want to pay those bills. You could have them all set to come automatically out of one paycheck, or if that doesn't work for you, you could have those split up and come out of your paycheck every couple weeks, or if you have a paycheck that only comes in once a month, if you wanted to have some of those bills come out the first half of the month or the second half, or if you want them all to come out at one time. And during that time, you'd also budget how much you want to spend on other expenses such as grocery, gas, fund money, your emergency fund, savings account. The next one is the cash envelope method, where you set aside cash each month. You put it into an envelope. And so whatever categories you have in that may vary by person. So I know I've tried this in the past, and I set aside funds for going out to eat during the week, groceries, fund money, my rent, my car payment, and then I put cash into those envelopes and I pay cash for everything. The next one is the 50-30-20 budget, and there is a little chart on the bottom of the screen that kind of outlines as a visual of what this looks like. So with this budget, you take your income, what you have coming in, and you would spend 50% of that on essential items, so things that you absolutely need to use those funds for. 30% would be non-essential items, and 20% of those funds would go into your savings account. The great thing about budgeting is you can try as many as you would like until you find which one is best for you. I know for myself, I take little tidbits from each type of budget and I created my own budget. It just works for me. You know, sometimes I need to set aside cash. It just works better to see the visual of, okay, I only have $20 left to spend, and I really ask myself, is it worth the $20? So where to start? you want to make sure that you're reviewing your bank statements. Take the time to go through and see where your money is being utilized. Make sure to list what income you have coming in, what expenses you have going out. And then also during this time, it's awesome to evaluate what services are you paying for that you're not using. Do you have a gym membership that you haven't used in 6 months because you've been working out at home? Do you have a Netflix account that you're not utilizing, or a Spotify account that you're not using? For example, the last time I reviewed my budget, I saw that I was spending $9.99 a month on Spotify. That may not seem like a lot of money, going out during a month, but I calculated in over a year, I was spending $120 on a service that I wasn't utilizing. So I downgraded to the free version. I'm fine with listening to ads. And I took that $120 and I put it into my fund account. So when I can start traveling again, I have a little bit of extra cash to use. And then it also, you could put those extra funds towards your savings account if needed. And some things to consider is to set up separate accounts for yourself. If this works for you, it's kind of like using the cash envelope system, but using it in an electronic form. So for example, I have my main checking account where my direct deposit comes in each month. And when my direct deposit comes in, I then transfer funds to my bills account is what I call it. I labeled it in my online banking so I know what it is. I transfer a fixed amount to my bills account and they automatically come out of that account each month. And then I transfer funds to my fund account that I also utilize for traveling. So if there's anything that I want to splurge on, or if I want to take a spontaneous trip with my friends, or if I'm saving for a long-term trip, I do set aside funds in that fund account. And then I also transfer the remainder funds to my savings account. So I allocate those funds and I have them labeled and I can see where those funds are being used. And then something also to consider is changing your bills to be due on the same time. So if you want to have, half of your bills come out on one pay period and the other half on the other one, set those up to match due dates so you don't have payments due randomly all over the month, and you kind of just have to plan and then and have them set up to come out automatically. It's easier to keep track that way. Oops, sorry. And the next step is finding the right tool for you. So there's a lot of great interactive tools out there, such as Mint, You Need a Budget, Pocket Guard. And if you bank with Gate City Bank, we have an awesome money management tool that has a great budget tool within where you can set goals to save money. You can plan for a trip. If you're wanting to pay off, say, a credit card or your student loans, you can set goals. And that tool is interactive and you can set time frames for yourself. So if you want to save for a trip a year from now and you need to save, say, $2,000 for that trip, it will show you how much money you need to save to reach that goal in that time frame. Another amazing feature about this money management tool is, I know for myself, for 2 weeks, I just set it up to evaluate where my funds were being allocated. So that way I can determine where I need to trim, where I'm spending my money. I found I was spending way too much money at Starbucks, so it gave me the dollar amount I was spending each week, and I was like, okay, so I need to cut back on that because I want to save more money for this and I can allocate it there. So you can see where you're exactly spending your money with that tool, which is amazing. And I'm going to leave you with a great tip. It takes time to earn money, so every purchase should be worth the time you spend earning your money. I know all women are working really hard in the workforce, and you want to make sure that you're spending your hard-earned money correctly and utilizing it to the best of your ability. And things to remember, one of the biggest mistakes we can get is forgetting big life changes. So having that emergency fund is important, or a big life change would be purchasing a home, and preparing for that and having a budget helps prepare for that. And then reviewing your progress as you go. If you're paying off things quick, adjusting your budget, maybe you can allocate more money somewhere else. Or if you get a pay raise, allocating those funds to move to another budget, whether that's more savings or paying down debt sooner. And then habits take time, consistency, making sure that you're sticking with it and being consistent with your goals and reviewing them on a frequent basis, so that way you're reaching them. And then some great resources that I utilize. Instagram is amazing. There's an account that I follow that's called female.infinance or female.infinance. Also searching the hashtag financial freedom. There's a lot of great accounts out there that offer so many amazing tips. And TikTok is also an amazing resource. Searching the hashtag finance TikTok. There's quick videos. So if you're wanting to find, tips on how to save for a home, or what the different type of home loans are, or how to set aside an emergency fund, or what to look for when purchasing a car, I have found resources out there on all areas of finance. And then one of my favorite podcasts, they recently released a finance episode. The Skinny Confidential, him and her podcast is amazing. They have an amazing episode that they recently released on finance, and they also have a lot of other great tips. And feel free to connect with me at any time. My contact information is on the screen. I would love to connect if you need help setting a budget, or if you've got questions. I would love to answer them for you.
Thank you so much, Brandy.
Yes, I do see there's a few questions, or one question, and I can answer those at this time, correct?
Yes.
Okay, so what is your favorite budget to use? I really love mixing budgets. I know sometimes I need to be a little bit more strict, so I have a harder time spending cash if I see it. So sometimes I use the cash envelope system. Using different accounts to set up my bills and transferring funds is important to me. And then sometimes I need to give myself a weekly allowance. It depends on what I've got going on. Just really mixing all of them together is what I love doing. And I'm kind of old school. I use the money management tool within Gate City Bank, but I also love using an Excel spreadsheet, because then I can paint everything out and move things around, and then I go input it into my money management tool.
You talked about having different accounts, Brandy. So what is the maximum amount of bank accounts you recommend opening?
Oh, that's a great question. I think it's based off of your needs. Some people do better. They really want an account for every single thing, and some people can work with 2 accounts or even 1 account. I know it's just something that I've worked through over the years, with myself even. I found that I do better having everything come into 1 account and then dividing it into 3 separate accounts. So my savings account, which I try my hardest not to touch, and then my bills account, that's just funds coming into it and then coming out. So, and then my fund account, it can range from what I have planned in the future. So I know it works best. I suppose that would be 4 accounts, but I know a lot of people make it work with even just 2 accounts. So.
Brandy, what do you recommend for irregular income? So where do you put that?
What do you mean by like just my regular income coming in?
Like irregular. So if you have income that's kind of sporadic.
Oh, so if you've got like a side hustle or something, that's a great question. You could put it into savings account, and it kind of goes with, the flow of life. So if you need to bulk up like your emergency fund, you need to put more money aside, I would maybe put it in there, or if you could put it into your fund account. I guess it kind of goes with what you've got going on in your life, or if you've got to plan for like a car repair or something, putting it into an emergency fund for that would also work. So I guess it kind of depends on what you've got going on in your life. But
somebody has a question that says, most budgeting apps start or reset from the beginning of the month. I get paid once in the middle of the month, and I have been struggling to make and stick to a monthly budget. Do you have any tips or resources for that?
Yeah, so we actually used to get paid once a month at Gate City Bank, and it was it's a transition when we went to biweekly, but what I used to do when we get paid once a month is I had all of my bills come out when we got paid, and then I knew what I had to work with for the rest of the month. And so I just set aside, I can spend this much on food, gas, groceries, and just really sticking to it. And if you're finding that it's hard to stick to that budget. Maybe even having some of your bills come out towards the end of the month or different times. But I know it worked best for me to have everything come out at one time, so I knew what I was working with for the rest of the month. So
Let's see. Do you recommend using net or gross income when budgeting? And do you have any preference?
net, because then you don't have to worry about your taxes unless you're self-employed. Obviously that's different. You would want to set aside funds for taxes too. I recommend putting that into a different account, but definitely using your net. Yes, because that's what you're taking home. So
how about explaining net versus gross income and what that means?
Yeah, so gross income is your income before taxes being taken out, and then net is what you're having come into your account each month with taxes taken out. I hope does that make sense?
Yes.
Yes.
Yeah.
Okay.
Well, awesome. I think that is most of the questions, but I was going to ask you too, what are some ways that you make budgeting fun for yourself, or like ways that you help keep yourself on track?
Yes. So I review my budget, I would say probably once a month, just to make sure I'm staying on track. And I find it fun seeing, seeing the numbers go down if you're trying to pay off like student loans. I know is a big one for people, seeing that number go down. And when you get something paid off, allocating those funds elsewhere. And I really am intentional about, taking care of myself too, and not stressing myself out. So setting funds aside to make sure I can go enjoy time with my friends, and if I want to take a spontaneous trip, that I can do that. So setting aside funds for that. And also, life is a lot easier to live when you can plan for the unexpected things. Not that you can plan for those, but knowing that you can, that you're prepared for that financially is also important. And I really enjoy going in and using those interactive tools and seeing where my funds are being utilized. And it's fun to see when you are staying on track with your budget and making way, and I can do it, and being consistent with it. So I just find it fun going and playing with the tools and seeing where I could be in, a month from now, 6 months, a year, and 5 years from now. It's really fun. And I know even out on Instagram, there's a lot of great visuals of, just putting even like, I saw one the other day, just putting like $25 in a savings account each week, and where that will leave you, at the age of 65. You could have an account with $1 million of just putting $25 away. So it's like, okay, is $20 at Starbucks worth it a week, or is $1 million more appealing to me at this time? So I think that's fun, and going out there and just exploring and interacting with those different accounts, and asking for help when needed if you're stuck or need a different perspective on things is also nice. I know it's not always fun to talk about money, but there's a lot of amazing resources out there, and I enjoy it, and I can make it fun if you want to come see me.
Awesome. Well, thank you so much, Brandy. And again, if you have questions for Brandy, her contact information is on the screen. So Brandy Haugen at gatecity.bank. Thanks so much for being here.
Yes, thank you for having me.
Awesome. Okay, we are heading on to our next presenter, Ashley Simmons. Welcome, Ashley. Oh, we still can't hear you yet, Ashley.
I think.
Oh, there we go.
There we go. Can you hear me? Okay, great. Good morning, everyone.
Good morning.
And just checking, can everybody see my screen?
Yes, we can.
Terrific. Well, hello, Ladyboss family. So excited to be here today. My name's Ashley Simmons, and just kind of a little bit about me and my background. I started my banking career when I was a part-time teller actually in college. And I quickly learned that banking is really about people. And I just fell in love with the whole industry. And my career really developed from helping customers to helping team members. And so coaching team members as well as really become my passion. And so I'm so excited and thrilled to be here with you today to talk about really having some easy steps to reach your savings goals with some basic strategies to really make it easy for you. So let's go ahead and dive in. So I love this quote. This is from Susie Orman. People first, then money, then things, right? This really captures my feelings about what banking and money should be defined as. We always want to put people first, and how do we serve our customers and how do we serve our team members is how we want to approach the money conversation too, and that's why we're here today. Money management can be so empowering for us and helping us achieve those goals, as well as just serve us well every day in our life. So I would love to hear from our lady bosses out there. What are some of the things that you want to set goals to buy? So maybe we can fill some of that chat box back up. And again, any goal goes. It can be small, it can be medium, it can be a large size. We want to see what you're saving for. What are some things top of mind? Seeing vacations, a new house. Yeah. And keep those dreams coming. They can be small or they can be really big. A home remodel. I love it. Thank you for sharing some of those things. When I was a banker helping customers, one time I had a customer come in and they shared with me that they were saving up for an adoption for their first child. And that was so special to be a part of. And that's when I absolutely fell in love with helping people and helping them achieve their goals. So, but we know, even with any size goals, some things kind of hold us back, right? So if you were to think about what holds you back, what would that be? What stands in your way from getting to that home remodel, getting to that vacation? Maybe it's even saving up for a new dog, or maybe a new car. What stands in our way from that? Can be some of those barriers. Feel free to type those into the chat box. Oh, that's a good one, Ashton. Debt. Yeah, debt can definitely hold us back, right? And even on the deeper side of that, a lot of times it's confidence or maybe our lack of financial literacy. We haven't had that education that we cherish, right? Or that we want and desire for our lives. Maybe it's being a multitasker, right? How many of you say, hey, I handle a lot, I manage a lot. A lot of us as women can raise our hand and say that, right? And so money sometimes becomes not the priority that it should be. And some of us also rely on our partners or our spouse to be that financial leader, because we haven't taken it over, we haven't handled the bills, right? So the first step is recognizing those barriers in your ways, and also knowing that you have so many resources available, and we're going to help you to see through those barriers. But the first step is, and Brandy talked about this too, is before we can save for our wants, we have to put our needs first, right? So we really need to factor in our needs. Creating that emergency fund for those large, unexpected expenses. I like to think of creating an emergency fund. It can kind of be uncomfortable, just like the cold weather in the winter, right? But when we prepare for that cold weather, we find the right jacket, we set our car up with an emergency traveling package, we feel more prepared to bear the cold, right? We're ready to go out in the cold. So same thing with an emergency fund. It helps us stay out of debt, which can be a big barrier for us to keep on saving. So think of, starting small. It's like putting that little side blanket that you have and throwing it in the car so that, hey, if I get stuck roadside, I at least have a blanket. That's what starting an emergency fund is like. So starting small, work to build somewhere between 6 to 8 months of expenses is really the goal. And also just setting a monthly goal, like I'm going to put this much amount towards my emergency fund with our budgeting, like Brandy talked about, into an account. So this is going to be my emergency fund account that I'm going to use when I need it, right? When there's an emergency. And then just another way to do that is using an easy access savings account. You can actually set up automatic transfers to that account. So you, again, can just kind of set it and forget it in a sense, knowing that you're building your emergency fund and you're doing those right things. And so again, it's all about finding what works best for you and finding the system that works best for you. So the second step is once we know, hey, we need to factor in our needs and our emergency fund, we want to really spend some time identifying those needs versus the wants. Brandy used a great example of Starbucks. I love that example, right? Do we really need that Starbucks every day? Or is it something that we can change to a reward for ourselves, right? So, hey, I achieved this in my financial, goal, and I'm gonna, I'm gonna go have that macchiato today. And I'm not going to feel bad about it because I earned it, right? So you can really start to change some of those needs to, a want and feel empowered by that and feel like you really earned it when you take that first step. The other part of reviewing some of those needs is really tracking your spending. So picking the budget that Brandy presented earlier, that's right for you. Like she said, she uses a mix of all of them. The money management tool kind of helps us identify all of the different spending that we do. So it will actually pull in all of your spending from all the different types of accounts that you use. So if you use a credit card, you can log into that credit card and it'll automatically categorize your spending. It'll show you, hey, Ashley, you're spending, $150 a month on coffee. And it has kind of that little, oh, okay, it's revealing. And again, that information can be so empowering. And then we know too is, prioritizing our saving over paying down debt. So this is kind of hard for some people to grasp because I think in the mentality is we want to get rid of debt, we want to erase debt too. And so for us to prioritize savings and having that nice cushion can actually keep us from going into more debt. And it kind of saves us from that. So that's why that emergency fund is so powerful because it can help prevent us from going into any further debt. And then after we've, set that that spending, we have a great way to spend our money that we feel confident and feel comfortable with. Then we're going to move into step 3 and we're going to say, hey, here's my goal. How much does it cost, right? So we assign a price to our goal. So for example, I know some of you said home remodeling, how much is that going to cost? And I don't know if any of you have ever done a home remodel project, but it always costs more than you budget for, right? Just always does than you anticipated. And the price of materials fluctuate. So, we don't know what the price of materials are going to be. So we want to really, again, give yourself some leverage of this goal might cost more and maybe even planning for that extra in your savings too. Be really realistic with yourself. When we think of all the costs, we can give ourselves that cushion as we need, and we can really set ourselves up for success, right? Rather than disappointment and be short of our goal. So what are some ways to kind of just get that goal going, right? I call it revving up your savings. I think earlier we talked about like that unexpected or irregular income. That's a great way to rev up your savings. Tax returns is another good one. Maybe you got a bonus. Selling used items, that's a hot market right now. People sell their used stuff all the time. That's a great way to say, hey, I'm not using this bike, or I'm not using, that coffee table, whatever it may be, sell it. Get some extra cash, clear out your clutter. That's always a great thing. Cutting back on those extras that we talked about before. And then I love this idea, observe a no spend day now and again. So guess what? Every day of the month on this date is going to be my no spend date. And it's just kind of teaching yourself that discipline and taking kind of that joy to like, hey, I did it. I made it through a no spend day. And you can just really kickstart your savings this way. And getting that really strong start too makes us feel good, right? It's like that momentum push that pushes us forward, and we feel really good about it. So let's kind of break this down into an example. If you were to say, hey, I want to take my family of 4 to Italy, right? How exciting, right? That sounds amazing. Now what? A trip of a lifetime deserves some thoughtfulness. So think about the cost of going on the trip, from like those bigger priced items like airplane tickets, your hotel, to some of those smaller things that we don't always think of, like souvenirs or travel insurance even. So if we were to give this a price, assign it a price, we're looking at, maybe $4,000 around for airfare, accommodations. We're looking at transportation costs, right? Tours and activities, our food, our souvenirs, miscellaneous, and travel insurance. So this is just an example of, hey, I'm going to give myself this figure of, 12,150. How could I tangibly reach that goal? Well, you can do this in a couple ways. You can use your budgeting tool, right? That budgeting that you have for savings. Once you've kind of built up your emergency fund, you feel confident about that. Then you could take 20% of your annual salary if you're really aggressive, and you can handle that, and you can save quickly 20%, $13,000 in 12 months. You can have that 10% of 65,000. So this just figures, this is just a simple math of, taking 20% savings if you can afford 20% savings, and if you want to be really aggressive about that goal. So these are just some examples. It might even be 5%. It could just be even starting at 2 or 3% that I'm going to dedicate to my trip to Italy. It's really about what works best for you and something you can truly, commit to. And many of us know this, that a dream becomes a goal when we have a deadline, right? So set a timeline, set a strategy, but don't beat yourself up when we don't reach it. It's okay to try again. It's okay to reevaluate and find out what continuously works for you. These are just some other tools that you can use to help you, again, achieve those ways of saving. So we have like a Simply Save program. A lot of banks offer that, where they'll round up your purchase. So say you go to, go to the grocery store and it's, $49.10. It'll take that extra 90 cents and put it right into your savings account. So it's just another great way to kind of be saving all the time. We also have the money management tool we've talked about, and you can set automatic transfers. So a lot of times banks offer free automatic transfers from your checking to your savings. And, at the end of this, be open to talking to a banker, going to talk to somebody who can help you and help decide what the best route is for you, and get that really personalized approach as well. And this is my absolute favorite step. After we track our progress, create accountability. We know that we need that accountability for ourselves. Make a money date, right? Many successful people have created self-care dates, scheduling time for themselves. Maybe it's to go to Target like Brandy talked about, or it's going to get a pedi and a mani. Maybe it's just having that time to read a book under a tree. Whatever it is that we need to center ourselves to feel mentally strong and physically centered, this is the same thing that goes for money, right? So to keep ourselves accountable, we can have a money date. Maybe you meet with your partner or your spouse and you discuss, where you're at with your progress. What did the spending look like last month? Were there any surprises, or do we have any new expenses that we're factoring in now? Many people are going back to work. Childcare is a new expense we're factoring into our budgets again. So looking at all of those different variables and just being really honest. And again, we know it's a scary conversation, but when you take that first step and you practice that, having that courage to talk about money, it becomes more comfortable. It's kind of like riding a bike. We get more comfortable as we keep going and keep learning. But remember, if you fall off the track from time to time, we all do, it's okay. You don't have to feel completely derailed. It's just get back up again, try something new, maybe change your tactic a little bit or tweak your process a little bit to keep moving and keep making progress on your goals is so important. And of course, celebrate those milestones. Get the small wins. Don't wait for a big accomplishment to celebrate. Celebrate the small wins. Maybe you made it 2 paychecks with putting money aside for savings. That's awesome. You should feel really proud of yourself. Rewarding ourselves for a discipline can also kind of make accountability fun and want us to earn it again. So don't be afraid to treat yourself to that macchiato at Starbucks once in a while. And as we kind of combined all the thoughts here, I think Susie puts it best here: live below your means, but within your needs. Finding that balance with anything in life is going to be key to sustainability, right? Feeling confident. Money can be really empowering. And do the next right thing. Make the next best choice for yourself. It can just start with something small to get yourself going. So we've also curated some resources for you to kind of, if you want to keep the thoughts going, keep your conversation going. We have our Women in Money podcast by Susie Orman. That's a good one. We have a book, Clever Girl Finance book, and Wise Woman Wallet. So I know there's tons of resources out there. These are just some more to kind of keep us encouraged, because I know when I'm trying to focus on something, whether it's clean eating or it's growing myself, I have to keep hearing and reading from those experts. I have to keep myself energized, and it's the same with finances. When we start to put ourselves with around like-minded people of what we're trying to accomplish, just like Ladyboss does, we start to feel empowered by it, right? We stay encouraged. So here's some resources for you. And I absolutely love connecting. So if you want to reach out at any time, I'm here to talk or point you in the right direction as well. So I'll leave it there. If there's some questions, Laura, from the chat box, or if anybody has any thoughts.
Yeah, if anyone has questions, you can put those in that questions box. But a question that I have, so if you're saving for a large, longer term goal, let's say we're saving for our trip to Italy, do you add in any short-term goals to kind of help you get excited for things along the way? Because if you feel like you're putting all of your extra towards saving for a goal that might not happen for 2 years, what helps you keep you motivated?
Yeah, that's a great question. I think so. I think setting little benchmarks for yourself, like the first $500, the next benchmark might be $1,000. And then when you get maybe to your halfway through, you go and buy an outfit for vacation. I think that's important, because you're right, having that really long-term goal out might seem like you're not even close to it. So it's just taking that time to maybe really divvy it up. Do what works best for you. If you need to do a $500 bucket, a $1,000 bucket, a $1,500 bucket, whatever that goal helps you stay motivated and makes it achievable, I think that's so important to reward yourself with the Starbucks, or buy a pair of shoes for vacation, get those sunglasses you've been wanting and desiring for a while. Absolutely.
Another question I have is, how do you feel about the apps, or maybe Gate City can do this too, where every time you swipe your card somewhere, it'll put $1 or $2 or whatever you decide into your savings?
Yeah, it's a really great feature. I've seen a lot of banks offering it. And Gate City does too with their Simply Save. So yeah, if you swipe your card or round up to the next purchase, the nearest dollar amount, you can easily save money. And it's kind of that you don't really miss it. So it really does rev up your goals. Another thing is using using a card for spend, getting a card that rewards your purchases. That's also something that we offer here. But pick a card that helps you maybe get cash back. Is another great way to, again, you're already going to spend the money and for your regular purchases, and then you can start to accumulate your points for cash back, which is another great kind of easy method to building that savings too. Great questions.
I don't see any other questions. Well, thank you so much, Ashley. I love those tips. Again, if you have more questions for Ashley or want to get in touch with her, you can reach her at ashleysimmons@gatecity.bank. Her phone number is also listed there on the screen. Thanks so much for being with us today, Ashley.
Thank you. It's my pleasure.
All right, we are going to go to Ashton Kusler. So I had an opportunity to talk with Ashton last week. We talked all about credit. And so I'm really excited to listen to her today too and dive even deeper. I think you're still on mute. Let's see. Still can't hear you.
Oh, how is that?
There we go.
Okay, round 3.
Wonderful.
Okay.
Thanks so much.
Welcome, lady bosses. So excited to be here. I think, one second here. There we go. Can everyone see my screen?
Yes.
Okay.
Yep.
Exciting. Okay. So, like I said, welcome. My name is Ashton. I'm a personal loan officer with Gate City Bank. I've been working with Gate City Bank for 9 years. I started as a customer service representative like the 2 previous speakers and fell in love with banking. I was 3 months away from graduating college and completely just disregarded where I was going to go to with my life, completely changed courses from emergency management to finance because I fell in love. And so I've been a personal loan officer for 5 years, and my favorite part of my job is helping my customers with their credit and just helping them understand what your credit score is, how you can get your credit score to improve, and all those different factors that come with credit. So we're just going to delve right in with what is some credit myths and facts with credit. There's so many information that's out there. So we're just gonna think to yourself here, what's this is a myth or a fact? It is better to leave a balance on your credit card rather than pay in full every month. Is that a fact or myth? Okay. Next, checking your credit will always hurt your credit score. Okay, fact or myth? And you should close unused credit cards to boost your credit score. Right? What are thoughts on that? And we're going to kind of go through these throughout the presentation, so just kind of watch for those answers. And moving on to what a credit score is, it's just, who knows, right? It just seems like no matter what you do to your credit, it always seems kind of this arbitrary number. So credit scores, in short, are a number that's assigned to you that determines your repayability on a loan. It tells lenders, are you able to repay a loan? And you might have heard the terms FICO and Vantage Score before. And really what they are there are 2 companies in the United States that use credit scoring models, and they pull your information from the 3 credit bureaus, Experian, Equifax, and TransUnion. And they put everything together, all your payment history, all the loans and credit cards you have, and they generate credit scores to tell your lenders whether you can repay a loan or not. And so the only other thing you really want to know with your credit score is that it's not just whether you can get a loan or a credit card with that credit score, but also, are you able to rent an apartment? Are you able to get a better interest rate on a loan or a credit card? Are you going to be able to, in some cases, your employer might check your credit to figure out if they should hire you or not. And also insurance companies can jack up your premiums dependent on your credit score. So really important knowing what your score is and trying to keep it healthy. So with that, we're going to go on to 5 credit score factors that really impact your credit and what you can do to improve your credit with these 5 things. So first off, payment history. Are you making your payments on time? Have you ever been late? When you've been late, how long have you been late? Next is credit utilization. This is going to be how much you use your credit. Do you ever max yourself out on your credit cards? And are you using your credit wisely? Next is length of credit history. This is the average age that you've had credit, how long you've had credit from the first credit you got to most recent. Are you establishing new credit? Do you have a lot of inquiries on your credit history, a lot of new things? And credit mix. This is, do you have a healthy mix of unsecured or revolving debt and installment debt? So revolving is going to be your credit cards, your line of credits, and installment debt is your vehicle loans, your mortgage, and your student loans. So you have a healthy mix of those. And you can see here how heavily weighted each of these factors is. So payment history and credit utilization, those 2 alone make up 65% of your credit score determination. So wild, right? So we're going to go into a little bit more detail of these 5 things and what you can do to improve your credit based on these. So first up, payment history. 100%, the single best thing that you can do for your credit is to make your payments on time and not be late if you can help it. So you can set up auto pay to help yourself kind of keep on track to at least pay the minimum payment. And if you want to pay extra, you definitely can. If you are going to be late, working on the teller line and also being a lender, if you're going to be late, please contact your creditor, please contact your bank, your whoever, and tell them that you're in trouble, that you're going to be late, and do what you need to do to set up a payment plan or work with them, hopefully to not report it to your credit, or if it is going to report to your credit, just let them know so that they can help you out as best as they can. If you wait, it can really be detrimental to your credit, and there's also less options for you the further it goes. So furthermore, if you do have something that's really gone badly, like a delinquency or a collection, try to pay those up as much as you can, because that will impact your payment history as well. And then review your credit report and fix any errors that you see on it. If you owe $25 to Verizon Wireless and that's something fraudulent that's not actually you, then you're being impacted by $25 to Verizon, and that's silly. So next is credit utilization, 30% again, so big chunk of change there. The lower you keep your credit usage or balance, the better. And you can't really impact what you're going to be doing on your mortgage or your student loans or your vehicle loans except for paying them down each month. So eventually your utilization will get lower on those as you make your payments. But what you can really impact is your credit card usage. So imagine, for example, that you have a 1,000 credit card limit on one of your credit cards, and 1,000 is the limit. You really want to stay under 30% of the utilization, which in our example is $300. And 30% is just the magic number that your credit score analyzing companies really like. You can go over the 30%, say you need to make a big purchase, but the 30% is what they like. And so you can do a number of things to keep that number low, but I highly recommend, if you can, keeping your payments so that you make your credit card balance to zero. Why pay interest on a loan or on a credit card if you don't have to? So keep it under the 30% and then use your credit cards. Try to use them at least once a year so they don't close out, just because they want to see that you can manage different types of debt. And if you don't use your credit, then they don't see that you're using your credit wisely. So next is length of credit history, which is going to be 15% of your factors there. So number one thing you can do on this is to leave your accounts open. They're looking at your average credit age. So if you open a lot of new debt, that shortens your average credit age. So it's important to keep your older accounts open and not let them become closed due to inactivity. And then next, more so, this is not as an important thing, but it's important to know how hard inquiries can impact your credit. So the more so that you get new credit, it's little dings on your credit. Hard inquiries are going to be, you are having an actual inquiry into your credit. You are applying for a loan, you are applying for a credit card actively. A soft inquiry is, like we spoke about earlier, your employer wants to check your credit, or your insurance carrier wants to check your credit, or when you get one of those mailers from your credit card company in the mail saying you're pre-approved, that's a soft inquiry. Okay, so hard inquiries can impact your credit about 5 to 10 points. So it's important that when you are going to check your credit actively, you want to be sure that you're really meaning that you want to apply for a loan. And the other factors that you can do with this is, if you are going to apply for a loan and maybe you're shopping around for a car rate and you're not sure which bank or which creditor can give you the best rate, try to apply within like a 30 to 45 day window, because that is what's going to really help you impact your credit less. So if you're in that 30 to 45 day window, it'll be one inquiry theoretically with the credit reporting companies, because they'll recognize that you're applying just for an auto loan. So try to keep it in the same kind of window there. And next, credit mix. Again, this is your revolving debt versus installment debt. So having a good mix of line of credits, checking reserves, things like that, credit cards as well, and then installment debt. So your vehicle loans, your mortgage, and your student loans. You want to have a healthy mix. Now, don't go out of your way to take on more debt, because again, this is only 10% of your score is factored with this. So don't go back to school to get a student loan, because it really won't help you that much, except for getting new debt, so not helpful at all. And then just kind of try to keep your accounts open and just have a healthy mix if you can, but again, don't go out of your way. So really, along with all these other gals here today, we just want you to understand your credit and just have like a healthy relationship. And then it just takes time to, set a budget, all the things that we've been talking about earlier, but it also takes time to get your credit and your financial wellness with debt to be managed. So in short, if I leave you with anything, make your payments on time, use your credit wisely and keep your balances down. And 3, take the time to establish your credit, make those payments on time for a long time, use your credit wisely for a long time, and you'll really go far with your credit history, and your score will really, really improve. So some tools and resources that I'm going to leave you with today. Annualcreditreport.com is my favorite. I use it every year. I go on my anniversary date with Gate City Bank is the day before Halloween. So every October 30th, I go and check my credit with the 3 credit bureaus, and I get them for free. Legally, we're all provided with that ability to get them once a year. The nice thing is that you get your credit history, so then you can see how your history looks, if there's any errors or anything like that. It won't give you your scores, but again, that's not really the important thing, because you're really looking for errors. And then another thing you can do is use a site like Credit Karma or any of those sites that help you kind of track where your credit is and credit monitoring. Those ones are great, but keep in mind that they're usually only one of the 3 credit bureaus is that what they report to. So it's nice to kind of do both if you can. So if you have any questions, feel free to email me or call if you have something that you want to ask after this, or if you have something that you're a little bit more sensitive about, definitely reach out. Love to hear from you. Again, favorite part of my job is helping people with their credit. So let's open it up for questions.
Thank you so much, Ashton. So one question that we have had come in, how do you manage credit well during a divorce? My understanding is you need to close all joint accounts, but then you lose your history.
Yes, so if possible, if you have anything that's the longest that you had before the divorce, try to keep that open. Also, try not to get a lot of new debt as you're kind of going. I know it's kind of hard if you need to like get a new mortgage under your name or get a new car under your name, if it's possible, try to avoid that. But really, it's going to be making sure that you make your payments on time. and it's hard with, you know, both of you making sure everything is good, but that would be the number one thing. If you're gonna get a lot of new credit or a lot of new debt, it's gonna hurt your points for a little bit, but showing that you've had that history beforehand and showing that you make your payments, that's gonna be the main thing helping with that.
So if you have a joint account with your spouse, let's say you're both on a credit card, is that affecting both of your credit, or is it really the person that's the main person on the account?
If you're both authorized signers, then it helps or hurts both of you. I had a friend who her fiance had co-borrowed with another guy on a loan, and the other guy hadn't paid that debt. So he had a charge off or collection on his credit report. And she wanted to marry him and then, you know, get a house and all that stuff. So what they did is she added him onto her credit card after they had paid off that collection. And adding him onto her credit card as an authorized signer showed the 15 years that she had had that credit card since she was 15. Those 15 years of good repayment history became his overnight, and his score jumped like 150 points in like 6 months because all that history had become his. Now, she didn't really want him to have that credit card. He really didn't care about it either, so they just shredded it, but he became an authorized signer and had that history transferred to him. So that's an idea. So it definitely impacts you to be an authorized signer, good or bad, as that example shows.
So would you suggest that someone have their own credit account, or maybe something that they pay on their own outside of their spouse to make sure that no matter what happens, they have some kind of healthy credit built up?
Yeah, I mean, I have my own credit, my husband has his own credit. You know, if you have something that you really enjoy, say like I shop at JCPenney, like my husband doesn't care for JCPenney, you can always just have one credit that you know is gonna work. But it's important to credit monitor all of your accounts, because if you're not really paying attention to something that you have joint, then it would really, really hurt you, no matter if it was your fault or not, just like as we said, is in that divorce example. So it's fine to have your own credit and show the history, but also pay attention to all of it so that you don't miss a payment and hurt your credit that way.
Can paying off a loan completely ever be detrimental to your credit?
Yes, it can be if it's the only thing that you have. I've had people who just starting out with their credit, they've had credit for a couple months and just started out at 18 and they closed their loan and now they have no credit. So they never actually got a score because they didn't have time to build that history and show that they can make payments. Also, I've had customers who are in their 70s and 80s who've paid off everything. And isn't it wonderful to be debt free? I completely understand their thought process on this, but paying off their mortgage was their last thing they needed to do. And 6 or 7 years later, when they needed to buy a car and they didn't have a credit card, they didn't have a loan for 7 years, they had no score. 60, 70, 80-year-old people who have just as much history as an 18-year-old high school student. Like, that's wild, but it can happen if you don't have any history reflecting for you. So yeah, it is bad to pay off a loan when it means that you don't have anything else going for you for showing that you can make payments.
So what do you recommend in that instance if you're about to pay off your last loan?
I would say the best thing is get something that maybe you shop at JCPenney for your for clothes, or if you use a gas card and you're always going to need gas, get something that you're going to use monthly for a specific purpose and just use it for that. And then it shows monthly that you're using it and it just rewards you for using it. That's why not do that. And then just it'll keep your history going. It'll show that you can make payments, and it'll keep a score going for you. Even if you don't have that credit mix we talked about, it's not a big deal if you don't have a mortgage or a car or whatever, but as long as you have something showing you can make payments, you'll at least have a score so that you can qualify for something down the road.
Okay.
Yeah.
What is the best way to use credit wisely to finance a side hustle? So at what point is it better to look for a loan versus a credit card, or maybe a line of credit?
I would say interest rate is probably the best thing, and also, do you have the funds to make those payments every month? So if you're going to have a loan, here's all the money up front. This is go out and do your best life and make your dreams come true. But a line of credit or a checking reserve is nice because then you're advancing a little bit at a time as you need it. And hopefully you can get enough from your side hustle to pay down those balances every month so that you're at zero. So I would say use the loan if it's going to be, I need all the money up front to start it, and use the credit card if it's going to be, I need a little bit at a time, and you're going to hopefully pay it down so you don't maybe pay as much interest on it. So really that's going to be cost to you driven is what I would pick based on that. And do you need the funds all up front right away?
Another question, what about creating credit for kids? Is there a way to do that?
Yes, so I had mentioned a couple slides earlier on the length of payment history. The best thing is to start your credit as soon as you can. And you can start credit for young people when they're teenagers. If you were to co-sign on a loan for your 16-year-old, they will start getting credit once they turn 18. So those 2 years of history that they make those payments, they won't reflect until they turn 18, and it'll just show up on their credit report that they had credit before 18, which is not a big deal. So that's an idea. You can co-borrow on a loan with them. Gate City and other banks do credit builder loans. So that's a loan where no parent, no co-signer, nobody helps them. It's just them. And we use just some other factors to help them get a $2,000 loan, say at Gate City, to just kind of show repayability and that they can make those payments, and then helps them get a score. Another thing is, like my friend, she added her husband onto her credit card. That's another idea. So a couple different things that they can do to kind of show history, either borrowing it from somebody else's history or starting it on their own or starting it with a loved one who will vouch for them. A couple different ideas there.
Is it better to pay off your credit card right when you make the purchase or wait until you get the statement? Like, I know a lot of people, they shop at Target and they go right away to the service desk and pay off their payment that they just swiped so they can get their 5% off.
Yeah, so I would say what you can do is like micro payments is you can set it to pay before it becomes due, just pick a day, or you can set it to pay like so much every couple days or so much every couple weeks, or just go in and right away pay it off. Especially if you get closer to that high utilization, you really want to keep your utilization low. So for me, I use my credit cards to get those reward points. So I pretty much use those exclusively for lots of everyday purchases like gas and vacations and things like that. So when I go and buy something that's a large purchase, so I got tires last week, or I'm going on vacation, I pay that right away because I know I don't want to get high on the utilization with all of my other, purchases throughout the month. And so I, after a large purchase, will pay it down, or if I know that something's coming, I'll try to pay it to zero and then let that vacation or the tire purchase go on there. So I would recommend trying to stay on top of that 30% utilization, however it works for you.
Last question.
Sure.
If you close your oldest line of credit to get a credit card with a better interest rate, does that hurt your score?
It would a little bit because you got the new credit, so that's a little bit of a ding. And then also, if you had that the longest amount of time, say you've had it for 10 years, that 10 years of history, say that your next longest thing is 8 years old, so then that average just goes down. So it will hurt it a little bit because it's, the 10% and the 10%, or 15 and 10%, just a little bit. But really, in the grand scheme of things, if it's better for you to do it that way, do it, especially if you're not going to get a new loan or a new credit line in the next few months. It would be worth it because it just makes more sense for you. Also, if it has annual fees, I do not like annual fees on credit cards. So if you have one of those and you can maybe transfer it to something similar within that same company, maybe then they can keep your same account number and card and everything, but it's just this kind of brand of credit card, I highly suggest that as well, because annual fees are just dumb in my opinion.
Thank you so much, Ashton. It's so great to get these questions answered. And if you have any more questions for Ashton, you can reach out to her at ashtonkusler@gatecity.bank. Thanks for being here today.
Thank you.
All right, we are going to be chatting with Kayla Getz. So Kayla is talking about something that I could personally really stand to learn more about, which is investing. Kayla, are you there? Let's see. There we go. Hi, Kayla.
Hello, everyone. How's everyone doing? I'm so excited to be here. Can you all hear me just fine?
Yes.
Good deal. Okay, so let's go ahead and get to the presentation. Can you see the presentation?
Yes. Yep.
There we go. Okay. All right, ladies. Well, I have to tell you, I am so honored to be here today with Ladyboss and all of you. My name is Kayla Getz, and I have been a financial advisor here at Gate City Investment Services for 8 years. I am a North Dakota bred hometown girl of Minot, North Dakota. I'm a wife and a mother to 3 children. So like most of you, busy is a word that comes out of my mouth daily. And so I would just want to take a minute and congratulate you for being here, taking the 2 hours out of your busy schedules and to focus on you and your finance. It is definitely the first step. So today, I'm going to share with you why it's so important to invest, what the process is, what some options you have are, and how to get started. But before we do that, I have to be very honest. Prior to 2009, I knew nothing about investing. I didn't know what the stock market was. I didn't know where Wall Street was. And it's actually a running joke here at Gate City that I asked my boss when I started if Charles Schwab was an advisor in Minot or in Fargo. For those of you who don't know who Charles Schwab was, well, he's still alive. He was an advisor back in the 70s, but he is now the CEO of a multi-billion-dollar company that holds investments for multiple individuals. So like you can see, anybody can learn how to invest. I'm living proof. So let's get started. Why invest? Well, easiest solution to that question, life happens and your finances can change in a millisecond. Let me share with you why I got into the business. Back in 2008, I was so excited because I had just had a little girl. She was my first. I had a great job at a little furniture store in West Fargo named Furniture for Less. Her dad and I just purchased a house. We had a few thousand in the bank. We thought we were doing good. We had good jobs. Sure, you know, we had a little debt, student loans, some credit cards, but we thought we had a good plan. Sadly, 6 months into 2009, he passed away. And my firstborn daughter and I were left by ourselves financially and emotionally. And I gotta tell you, it took a toll on me. It rocked my world. And so I decided that I'm gonna take control of my finances. And I met with a financial advisor. And he taught me the basics and advantages and how to get started. Pretty much the same principles that I'm going to go through with you today and what I teach my clients every day. And when I met with him, that was it for me. I traded in my furniture, selling shoes, and I became a financial advisor. And I've been doing it ever since customers here at Gate City and the surrounding communities. So let's get started with the principles that he taught me back in 2009. The advantages of investing. Well, there's 3 of them. Building wealth through compounding growth to help outpace inflation. Advantages. Building wealth through compounding growth to help pace inflation. Well, aren't those long finance terms? I don't want you to worry though. I'm going to go through each one in detail, and hopefully you'll have a better understanding of each one and feel empowered when we're done. So let's start with building wealth. Well, building wealth, I hate to break it to you guys, but it's a marathon. It's not a sprint. Even with investing. Investing is not a get-rich-quick strategy. It takes many years to build wealth through investing. Just ask David Bach's grandmother, Rose Bach. For those of you who don't know David Bach is a world-renowned author of finance. He's written many books. I've read them all. I urge you go out and find one. One of his books, he wrote a story about Rose Bach, his grandmother. Rose Bach, back in the 1950s, she was tired of being poor. And she had to make some life choices, some changes, really. Just like the changes that the girls were talking previous to me, she made a lifestyle change. And instead of going to lunch with the girls Monday through Friday, she decided to bag her lunch. And the money that she saved every week, she decided to go down to the New York Stock Exchange and invest it. She did that consistently over her lifetime to the point where it changed her family tree when it came to finances. So much that her grandson, David Bach, wrote a story about her. Now, how did Rose Bach change her family tree on 50 cents a week? Surely if she put 50 cents a week into a coffee can, she wouldn't be able to change her family tree. Well, you're absolutely right. Rose Bach knew this. And she decided that through investing, she knew there was this power of compounding growth that you could get in the investment world through the stock market. Compounding growth is simply money growing on top of money. It's that simple. Today, though, we're going to play a little game, a little bit of make-believe, and hopefully you can all have a takeaway so you can remember how powerful compounding growth can be. So, everybody, I want you to pretend that you have all won the lottery. You've won the lottery, you've won the lottery, you've won the lottery. I am so excited for you all. Now, you have to choose how much money you've won. Option 1 is $1 million. $1 million. I'll give it to you today. Okay, so option 1 is $1 million. Option 2 is a penny today. That's right. Good old Abraham Lincoln. A penny today. But there's a little catch. I will double the value every day for 30 days. So do you want to choose the $1 million today or the penny today, and I'll double the value every day for 30 days? Take a second, figure out your choice. All right. As you can see, if you chose option 2, you would be 5 times richer than the person who chose option 1. That is compounding growth. Look at the chart here. You can see the money growing on top of money in the first 10 days. There's not that big of a change. You can see it starting to work on day 20, but boy, does it ramp up in the last 10 days. On day 30, you'd have $5,365,709.12. A millionaire. That is compounding growth. And that is how Rose Bach changed her family tree. Not in 30 days, but in over 3-4 decades, her lifetime. It takes time to build wealth. Now let's transition into inflation. What is inflation? Another crazy finance term. Well, inflation, in simple terms, is the increase of prices on products we use every day. Let me say it again. It is the increase in prices on products we use every day. The only way you can try to build your wealth, to try to outbeat inflation, is through investing in the stock market. Because we've already determined that if you put that 50 cents into a coffee can every week, you're probably not going to change a family tree. So, my favorite example, I do this with my retirees when they retire, because it never fails, never fails. My clients will retire, and the first thing they want to do is go out and buy a brand new vehicle. Typically up here in Minot, it's a Chevy. And I'm partial to Chevys, so we're going to use that as the example. So I always am very excited for my customers. They come in, they drive in, it smells new, it's shiny. They're very excited. It's the present to themselves. They're celebrating their accomplishment. Now, I'm not looking to damper anything, but I do like to help them keep conscious of the money they're spending. So I like to ask a little question. How much was your first vehicle when you started in the workforce? They all chuckle, all of them chuckle, and say, oh, not as much as I spent on this new Chevy, for sure. And I'm like, I asked them, was it $500, $800, $1,000? They all have a number right between there. They know the make and the model, they know the color. Man, they loved that first car. And then, sadly, I asked them how much a payment was going to be on this brand new vehicle. And guess what? The monthly payment is about as much as they paid for their first vehicle. That's inflation. $1,000 in the 1940s got you a long way than it would today, right? So by investing over a long period of time to build wealth with compounding growth, you might have the ability to beat inflation for the rising costs of the products we use every day. All right, well, we went through the why we should start investing. We went through some advantages, but we still haven't gotten to what is investing. Well, there's a two-part process, okay? So there's the process and then there's the choices. So first we're gonna go through the process and then I'm gonna share with you some choices. In my opinion, the process is way more important than your investment choices. So I want everybody to turn up their volume because this is by far the most important part of my section. Before you start choosing investments, you have to figure things out with your finances. You have to organize them. You have to make sure your emergency fund is fully funded. You have to make sure that your cash flow is adequate, that you can start allocating money towards investing. Also, you got to figure out what you're going to invest for. Is it for retirement? Is it for a 20-year wedding anniversary trip? Is it for your kids' college? There are a lot of different goals out there, and everybody is different. So first, you have to figure out what your goal is. Next, you got to set a timeline. How long before you're going to need that money? Is it 40 years? Is it 10 years? Is it 7 years? Each timeline is going to be different for each goal. So organize your finances, figure out your cash flow, set a timeline, find your goal. Next, we got to figure out your risk tolerance for the stock market. Investing is like a roller coaster. The stock market has ups, and then it has downs, and then it has up, and then it has downs. It is 100% uncontrollable, unpredictable, and no one can see the future. The only thing that we do know historically is if you do invest in the stock market over a long period of time, you have the ability to gain more money than putting it in a coffee can. So, big roller coasters are for long-term aggressive growth or growth investments. Smaller roller coasters are for more conservative investors. They're going to have small ups and downs. For a visual, think like you're at the Cass County Fair. I like to think of the Ward County Fair, but it's a roller coaster you put a 6-year-old up, where the bumps are not as big and volatile as a growth investment. So growth investments, big roller coaster. Conservative investments, small roller coaster. What appetite do you have? All right, so we have figured out the process and we're ready to choose our investments. There are thousands of different things you can do. Today, though, we're going to focus on the top 4 you probably hear every day and that are typically used in 401ks in personal investments. So let's start with, in my opinion, some of the riskiest ones. Stocks. Stocks are simply ownership of a company. So if you decide you want to get on the big roller coaster and purchase a stock, you're just basically saying, here's my money, and I'd like to be a part of your company. Now, when that company has profits in a year, they might give you a percentage of those profits back through a form of a dividend. Another way you can make money by owning a stock is if the stock price goes up. If you purchase a stock at $50 and the company becomes very popular and lots of people want to buy that stock, well, through supply and demand, your stock price will go up. So if your stock price goes up to $100 and you decide to sell it, well, you just made yourself a $50 profit. However, you are putting all your money into one company. So be mindful of a company that you choose, because if that company goes under, bye-bye goes your money. Now, let's switch roles and go into a more conservative investment that is complete opposite to stocks, bonds. Now, if you purchase a bond from the federal government or a company, you are not saying you're becoming an owner like a stock. You are simply saying that you want to borrow your money to the federal government or to that company for them to use to improve their company or build a school or build a new building. and that company decides that they're going to pay you an interest rate on your money for a period of time until they're done using it. When they're done using the money, they give it back to you. So bonds are considerably less riskier than stocks. Okay, now we got those two in the middle, mutual funds and exchange traded funds or ETFs. Wow, okay. Diversification. Let's talk a little bit about that because that's the reason mutual funds and ETFs were created. So back in the day, there was only stocks and bonds. That's all you could get. You could go down and buy a stock at the New York Stock Exchange, or you could get a government bond from a federal government and help them fund a war. But that can get very expensive quite quickly. And you're not diversified. If you had one company stock and one bond, well, if the company goes under and the bond defaults, you lose all your money. You want to own lots of different companies and own lots of different bonds. And the only way to do that is through a mutual fund or an ETF. So they're both constructed pretty much the same way. When you have a mutual fund or an ETF, I want you to imagine an umbrella. And you're purchasing the umbrella. But underneath that umbrella, there is hundreds to thousands of different companies. So you may purchase one umbrella, but you have exposure to many different companies under there. Diversification, spreading your money out to lessen the risk of your investing. That's why mutual funds and ETFs were created. Now, there is one distinct difference between a mutual fund and an ETF. Mutual funds are traded at the end of the day, and ETFs are traded throughout the day. It's the only difference. ETFs are traded during the day, and mutual funds are traded at the end of the day. Okay, so we have gone through why we should invest, advantages of investing, what the process is. I gave you some options. Now the most important question, how do I get started? Well, there's really only two choices. You can do it yourself, or you can hire a licensed financial advisor. I'm going to walk through both of them with you. Do it yourself, we'll start with. If you're going to do it yourself, there are many fabulous platforms like Acorn, Robinhood, E-Trade that are designed to help a user purchase and sell investments in real time. It's very convenient. It's also quite cost effective, and you can do it on your phone. One of the things that these platforms will not do for you, though, is they will not do the research for you. They also won't help you buy and sell. When's the right time to buy? When's the right time to sell? They also don't know your full financial makeup. And so if you're going to go do it yourself, make sure you have the time to do the research and the stomach for the market volatility of the ups and downs of that roller coaster. Okay, let's transition to licensed financial advisor. Licensed financial advisors are licensed in investments. They can do the research for you. And typically, they know your whole makeup, all your finances, what your goals are, what season of life you're in. They care. I like to say the main purpose of a licensed financial advisor is to help you remain confident in your finances. Because like I said, life happens, and our jobs are to help you regain confidence when you lose it in different seasons of your life. Now it's total personal preference if you do it yourself or if you hire a licensed financial advisor. But that's not the biggest takeaway of this session. The biggest takeaway of this session is to just get started. Be consistent and have patience. Now, in the next slide, I have a few of my favorite resources, books, podcasts, and information for you to consume. Take the time. You've already taken the first step. You're here. So make sure you plan out in your calendar to dive a little bit deeper in what investing is and the little tips and tricks you can learn along the way. And if you ever get stuck, I'm only a phone call away, and I am happy to help you in any way I can. Okay, now it's time for questions. So what kind of questions do you have?
Thanks so much, Kayla. We have a question. Somebody is asking about the book that you mentioned right at the beginning. What was the name of the book from David?
The Latte Factor. He's written many books. So on The Latte Factor, he touches on his grandma a little. I haven't had the privilege of reading his most recent book, but if you Google his most recent book, it is all about his grandma. And I haven't had the privilege to sit down and read it myself, but David Bach is definitely one of my favorite resources.
Question that came in, what sort of investments do you recommend for people in their 20s? S&P, or should we find specific companies we want to invest in?
Well, it all determines on how much time you have and how savvy you are in the research that you want to do. So let's look at the timeline. You're in your 20s. First, what are you investing for? Are you investing for retirement? Because if you're investing for retirement, historically, you have all the time you need to be as aggressive as you want in the investments that you choose. But if you don't know what companies you want to invest in and you're looking for just how to grow your money over a long period of time, I would really urge you to look at the diversification of mutual funds, because then you'll be able to have multiple different companies in your portfolio and someone will be there to help you manage it, because that's what the mutual fund companies do.
All right, we have to move on to our last speaker. So thank you so much, Kayla, for being here. And thank you for sharing all your wisdom on investments. If you have more questions for Kayla, you can reach out to her at kaylagetz@gatecity.bank. Thanks so much.
Thank you, Laura.
All right. Let's go to our next panelist. We have Hannah Sorensen. So Hannah is going to be talking about retirement, which honestly is something that I haven't really thought that much about yet, but I've been told that I am in the age group of geriatric millennial, so maybe I should be thinking about this. Welcome, Hannah.
Thanks for having me. Can you hear me and see my screen?
Yes.
Wonderful. Yes, I thought that was interesting when that article came out about being a geriatric millennial and how we relate to more people in the workforce. But it's also that reminder that retirement isn't forever away. So it's a great time for us to be having that conversation. So I'm excited to be here today. I look forward to having this conversation with you. So, I did not dream about a career in financial services. From third grade until my freshman year of college, I wanted to be an electrical engineer. I was so excited to go to school at NDSU. And then I had my first course, digital systems. Studying binary code and ones and zeros just wasn't exciting to me. I quickly realized that I wanted to interact more with people in making my impact on the world. Even though it took several major changes and I finally double majored in business and marketing, it wasn't until getting laid off from a job that I started my career in financial services. I want you to keep that in mind when we're going through this information. This isn't something that came naturally to me. I definitely, in my first job, took that packet of benefits information and put it in a drawer and didn't know what to do with it. So remember, everybody's situation is unique. We all have different goals, and it's really important to work with a financial professional that can help you understand your situation and your goals. There isn't a cookie cutter solution. The goal for you today in the material we're going to cover is for you to understand what are your next steps based on where you're at now, and what are those things that you can control. We're first going to start with a visualization exercise. This is really an important piece of your retirement picture. What does retirement look like to you? Have you thought about this? You've handed in your laptop and your keys, and now every day is Saturday. You get to enjoy those things that you've been wanting to do your entire life on a regular basis. Does that look like traveling the world? Are you going to be with your grandkids? Do you enjoy gardening at home? Maybe it means getting a part-time job that brings you joy. I loved hearing from a client that was looking forward to delivering flowers in her retirement years. She had worked a high-stress job for years and wanted something that would bring people joy. Now, why does it matter to visualize what retirement looks like? Why am I asking you to really clarify that vision? Well, one of the most common questions that I hear is, how much do I need to have saved for retirement? When I decide at 60 or 65 or 70 that I'm ending my working career, how much do I need to have so I know that I'll be okay, that I can live that lifestyle I want? And what I'll tell you is that it depends. It depends because each of those different lifestyles I mentioned cost a significantly different amount of money. If you're going to travel the world versus staying home and enjoying gardening and staying local, that dollar amount looks quite a bit different. So you really need to understand, what does that look like to you and what lifestyle do you want to have? And when I talk about visualizing that and taking the time to really plan for that future, think about how much time we spend planning for other events in our lives. A wedding that lasts one day, we may have spent 12 months or even 18 months planning for. A vacation that lasts a week might have spent 3 or 6 months planning for that. Retirement could last decades. How much time have you put into planning for that? If you think about if you retire at 65, you could easily live till 85. That's 2 decades. So make sure you're taking the time to actually plan and actively be involved and really see, what does retirement look like to you? So we've heard about a lot of different concepts today, and we're really going to look at, how does retirement fit into your overall financial wellness picture? We're going to look at a financial pyramid. So earlier, you've heard about your credit and budgeting and setting goals and investing. Well, when we're looking at our financial picture, it really starts with our income and that budget. There's so much money coming in, and we want to make sure that more than that isn't going out. We want a strong financial foundation for those unexpected events in life. We talked about saving for that emergency fund. So if something unexpected occurs, you're able to pay for that and not impact your credit score, not struggle with debt. So really think about this is building up. Where are you at now? Do you have a strong foundation where you're protected from an unexpected illness or something like needing tires? And then are you starting to save for your goals? Maybe it's that vacation house and maybe it's retirement. Really think about where are you at now? Maybe you started saving for retirement with your first job. You've been saving for the last 10 or 15 years, and maybe you're just getting started. You've had other things that you've focused on, like building up that emergency fund or paying off debt, and it's time that you're ready to get started. No matter where you're at, it's important that you're taking that active role in your financial wellness journey. So there are certain tools available to help you save for your retirement goals. We're going to really look at what those tools are that are available to you. Now, the IRS gives you certain tax benefits if you use the tools that they've made available to you. You might have heard of a 401k or a 403b or a 457 or an individual retirement account. Those are just tools available that give you tax benefits to save for retirement, as long as you keep those dollars invested until at least age 59 and a half or later. So we're going to dig deeper into those tools and understand what might work for you and really what makes them unique and helpful in saving in our retirement journey. First, we're going to look at the two main groups: employer-sponsored plans and individual retirement accounts. So 401k, what does that even mean? Why is there that number? That number is part of our Internal Revenue Code. It's just a subsection of the code saying that you're going to receive specific tax benefits if you save for retirement in this vehicle. A 401k is an employer-sponsored plan. That means you need to be working at a business that has a 401k. Now you might say, my employer doesn't offer a 401k. Maybe it's a 403b or a 457. Those are just for specific industries that you might work in. But they're all employer-sponsored plans. So you need to have payroll income, and then you're able to make contributions for retirement through payroll deductions. So each paycheck you're contributing for retirement. There's also the ability that an employer can make contributions. So maybe they offer a match, or maybe they do profit sharing. There's different ways that your employer might help you save to reach your retirement goals. Now, an individual retirement account, or IRA, is something that you set up on your own. It's not tied to your employer, it's in your name. You make contributions from a savings or a checking account, and you can do that maybe monthly, or if you want, on an annual basis. Some people do that when they file their taxes annually. They'll make that contribution. Now, the contribution limits are quite a bit different for the 401k versus the IRA, as well as those catch-up contributions. As we move closer to retirement, we're able to save a little bit extra to help us catch up to what our goals might be. Maybe we got started saving a little bit later in life. Now, an IRA only allows you to make individual contributions. So your employer isn't going to be contributing to your IRA. The investment selection can vary between the two accounts in that you have lots of options in an IRA, where in an employer plan, you're limited to that plan lineup. So which one might make sense for you? It's really going to depend upon your situation. Understanding what's available to you, what are the level of service that you would like to have, what are the fees in the account, and then maybe you're self-employed and are looking, what are those options as well? It might look very different for you. But those are the two main categories of retirement accounts. Now, we talked about that they have tax benefits. That's why we're really saving in these accounts. The government is giving us tax advantages because we're saving for retirement. So let's go through those differences, remembering that both of these types of accounts allow us to have both options. Pre-tax and Roth. When we think about pre-tax, this is going to be the traditional way we've thought about saving for retirement. When somebody said 401k in the past, typically it's always been a pre-tax contribution. Or an IRA, that individual retirement account, pre-tax contributions. So what does that mean? Well, it really means that we think we're in our highest income earning years now, and that when we're in retirement, we're going to be in a lower tax bracket, and we'd rather pay those taxes in the future when we're in a lower tax bracket. So really think about that. Why does that understanding your budget matter? Why does understanding what retirement looks like to you matter? Well, because we're trying to optimize our tax situation. It's a great conversation for you to have both with your accountant and a financial professional that can help you navigate this. So when you think about that pre-tax contribution, think if you contributed $50 today, you're going to retire 30 years from now. If that $50 grows to $300, you're not paying income taxes on that $50 today. But when you retire and you start taking out that $300, you're going to be paying taxes on that $300 at whatever tax rates are at that point in time, and at whatever tax bracket you're in at that point in time. So think about that. It's deferring the taxes. Now, Roth contributions are the opposite. Now, you can have Roth 401k or Roth IRA. They're just different buckets of money. So the Roth allows you to pay income taxes today. So you're saying, you know, I think income taxes are lower today than they're going to be when I retire. I think taxes are going up in the future. Or I think I'm in my lower income earning years now than I will be in 10 or 20 years from now. So if you think about that same $50, you're going to pay income taxes on that today. But if it grows to $300 by the time you retire in 30 years, you're going to take out that $300 tax-free, as long as it's been in there at least 5 years and you're older than 59 and a half. So it's really determining, where do you think taxes are going? Where do you think your tax situation is? And finding a balance. We don't have a crystal ball. We don't know exactly what that situation is going to look like for you or our tax brackets, but you can allow yourself to have tax diversification and have flexibility in retirement. So we've discussed really the main tools that allow you to save for retirement, what sets them apart with the taxation, but let's go through the items that you want to focus on, that you can control. Your savings rate, taxation, and investment selection. How much should you be saving for retirement? A general rule of thumb is 10 to 15% of your income. Now, this could vary a lot. It depends upon when you started saving. It depends upon when you want to retire. And it depends upon what that retirement looks like to you. If you want to retire early, you might need to be saving more than that. Just keep in mind, it's not something you set and forget. Maybe you started a job 5 years ago. Do you know what you chose as your contribution rate? Now is a great time to review that. Maybe you started a job recently and haven't started contributing yet. Take the time to go through that process. It doesn't matter if you start at 1% or if you're at 14% and trying to increase to 15%. It's a great time to get started. You can make it a habit that each year you increase your retirement savings 1 or 2%. It's a great way to make it a consistent habit that you stick with. It's often difficult if we make big changes where we jump from 0 to 10% and all of a sudden our budget feels very tight. So make those changes that you really can be consistent with and stick to. Next is taxation. We talked about that difference between pre-tax and Roth. And why does that matter in retirement? And why do we want to be thinking about that? Remember that we have a marginal tax brackets, marginal tax rates. Different dollar amounts are taxed at different percentages. The more income we make, those later dollar amounts are taxed at higher rates. So maybe there's a year in retirement where you want to take your whole family on a vacation, or maybe you're buying a vehicle and you don't want to bump yourself up a tax bracket. That's where if you would have saved Roth dollars, you'd be able to take out some dollars tax-free that year. Remember, any contributions your employer makes are always going to be pre-tax. So review that. Think about how that fits into your picture and how that can offer you flexibility in your retirement years. And then there's investment selection. Kayla talked to us about that roller coaster, the ups and downs that you're going to see in your account, as well as risk tolerance. And it's really important for you to understand what is your risk tolerance. How much can your account go up and down, and are you still okay and able to sleep at night? If you haven't looked at what your investments are in your 401k or IRA, review that. Take a risk tolerance questionnaire. Typically in 401ks, we'll see a few different options, maybe a target date fund, a risk-based model, or you'll create a custom portfolio from the mutual funds available to you. Now think about a target date fund. What does that even mean? It's really looking at everybody in your age group and saying, here's the mix of stocks and bonds you should have based on your age group and timeline until retirement. Now think of everybody in your high school class. It's putting everybody in your age group in the same exact mix of stocks and bonds. Do you think everybody in your class has the same risk tolerance? Probably not. So it's good to review and see if that target date fund, if that's what you're in, makes sense for you. If you've created a custom portfolio, but it's been a while since you've reviewed that stock bond mix that you've chosen, look at that. As you move closer to retirement, we typically become a little bit more conservative as we want more stability in our accounts. If you chose something at age 20, you probably don't want to be in that same investment at age 50 or 65. So remember, this whole process is not about setting it and forgetting it. So when we're thinking about this, it's really about freedom. When we're talking about our finances, it's making sure that we're taking control of a situation so we can have the lifestyle that we want. There's often resources that are helpful to us to make us easier to reach our goals. One of my favorites is a recent podcast from the Wall Street Journal, Your Money Briefing. On May 27th, they did a podcast about couples and risk tolerance differences. That's a great one to review if you've ever had a discussion and you differ with your significant other on how much risk you want to have in your portfolio. Now, we covered a lot of information today at a high level. And again, everybody's situation is different. So it's important to make sure that you understand where you're at, and feel free to reach out with any questions that you have or ask them now, as it's very likely somebody else has the same question.
Thanks so much, Hannah. A question that came through is, can you have a 401k and IRA?
Yes, you can often have both. There's different rules for contribution limits and what those deductibility options are for you. So you just need to look at your specific situation and ask questions about that.
Wonderful. So we are just about out of time. If you have more questions for Hannah, feel free to reach out to her at hannahsorensen@gatecity.org. bank. I'm sure she would be happy to help out. Thank you so much to all of our speakers today. It has been a whirlwind. I know my head is kind of spinning, but I know so much more now than I did just 2 hours ago. So thank you for sticking with us, Lady Bosses, and I hope that you take at least bits and pieces of what you learned today and put them into practice right away. I will let Hannah go here. Hannah, if you want to turn your camera off, wonderful. Perfect. Thank you again, Lady Bosses. I will be sending out a recording of today's Money Lab, so you'll be able to go back and replay any of the sections that you want to brush up on or things that you have missed. I also really highly encourage you to reach out to Brandy, Ashley, Ashton, Kayla, or Hannah if you have any further questions and you really want to put what you learned today into action. Their contact information is on the slide deck and you'll have access to that as well. Before we sign off today, I also want to plug our 4th annual Lady Boss Summit coming up on August 5th. It's always our favorite day of the year, and this year is no exception. We've got incredible speakers, panels, breakout sessions. You won't want to miss it. You can find out more information about our virtual summit and all of our upcoming events on our social media channels at Ladyboss Midwest and at ladybossmidwest.com. Thank you again for being with us today, Lady Bosses, and another huge, huge thank you to our speakers and to our event sponsor, Gate City Bank. We will see you again soon.